Hey, what's up everybody? In this video, we're going to cover some of the top mistakes or just top things that you need to know about an S corporation. So I'll create other videos where we go into each one of these in a little bit more detail. But in this video, I just want to cover a brief summary of what those key things are and what you need to start looking into if you're going to be, or if you are, an S corporation. The number one error or thing to be aware of with an S corporation is the difference between an S corporation and a sole proprietor business. So if you were a sole proprietor, a self-employed person filing a Schedule C on your personal tax return, and now you've elected to be treated as an S corporation, that corporation is now a completely separate entity from you, has to file its own tax return. All right, the key here is you have to receive a W-2 from that S corporation. You are now not only an owner, but an employee of your S corporation. You need to be paid wages and receive a W-2. The reason why this is such a huge deal is because there are still, honestly, CPAs, enrolled agents, tax preparers out there who are preparing S corporation tax returns and not advising their clients that they have to be on payroll. I see new clients come in and say, here's my S corporation tax return from last year, and the first thing I look for is the payroll. And there is zero wages, and everything is paid to the owner as an owner distribution. That is not okay. The IRS will catch that, and they will come in and recharacterize your owner distributions to wages, and you will owe 15% basically in Social Security and Medicare taxes, plus penalties and interest on what you didn't pay in payroll taxes. Now, what should the wages be? Because this is also the other key factor. You'll find blog posts and articles. You'll find preparers, CPAs, enrolled agents that you sit down with. Hopefully not very many, but you will find some who will tell you, hey, let's just do $20,000 in wages and the rest can be owner distributions. Or pay yourself, whatever you make. If you make $100,000, your reasonable salary can be 50% of that, or $50,000, and your owner distributions can be the other $50,000. Just, do 50-50 split, or do a third and two-thirds split between salary and distributions. None of those will fly if you get audited by the IRS. Now, the fact that you have some salary and you put that on the tax return, the IRS honestly isn't super great at catching this. It doesn't appear. Now, they might be ramping those efforts up, but it doesn't appear as though they're very great at catching this as long as you have some salary. So a lot of preparers are out there putting some salary on there, and they're getting away with it, quite frankly. But if you were to get audited, the IRS is going to come in and say, how'd you come up with this salary? Is it reasonable compensation? And what I tell people is, you need to pay yourself what you would pay someone else to do your job. That's what's reasonable. So I subscribe to another service where, we use that service to document what the actual salary is for your position in the area of the country and the city that you live in. All right, it gives us something to stand on if you get checked on your salary. So that's the biggest thing. Reasonable compensation. You need to be getting paid something from your S corporation. If you're not, or it seems low based on just the normal, what would I pay someone else to do this job if I wasn't doing it? You need to ask your preparer about it or move on to another one, honestly, if they haven't advised you well in this area. So the second one is, maybe you're not actually an S corporation. So to be an S corporation, you have to file an election with the IRS. Okay, so you might be an LLC, a limited liability company, in which case you filed your articles with the Department of State or the Secretary of State. And so legally you have that entity. Or you've incorporated in your state, in which case by default as a corporation, you're a C corporation. And if you're a single member LLC, by default, it's disregarded for tax purposes and you're a sole proprietor. Or if it's a multiple owner LLC, by default, you're a partnership. So under any of those situations, you have a legal entity, but you have to file a Form 2553 with the IRS to elect S corporation status. Otherwise, you're not actually an S corporation yet. The next one is health insurance. So you can qualify for the self-employed health insurance deduction. This is a huge benefit when you have an S corporation. You can actually qualify for this with a Schedule C business too. The key factors here are you can't have other health insurance available to you. So if you have another job where health insurance is available to you, you can't get the self-employed health insurance deduction. If your spouse, if you're married, has a job that you could be on their health insurance, then you can't get the self-employed health insurance deduction. Even if you choose not to be on it, you still can't get the self-employed health insurance deduction. Basically, there has to be no other health insurance available to you through an employer. And the corporation, the S corporation, has to pay the premiums for the health insurance, and the health insurance has to be in the name of the owner. So if you're married and you're the owner of the S corporation, it can't be in your spouse's name. It has to be in your name. So the corporation has to pay the health insurance premiums. It can reimburse you for those, or it can just pay them directly. It gets added onto your W-2, and then it gets backed back out on your personal return through the self-employed health insurance deduction. But you have to make sure you meet the qualifications, one, to get the self-employed health insurance deduction. You have to make sure that you handle it appropriately based on who's paying the premiums. And then you have to get it on the W-2 and on your personal tax return in the right way to benefit from it. But health insurance premiums can be a huge benefit of having an S corporation. You just have to handle it correctly. All right, the next one is kind of all wrapped up. There's a couple here, but they're all wrapped up together in the fact that now that you have a corporation, you need an accountable plan. This has to do with company reimbursements. So business expense reimbursements to you personally. When you were a Schedule C sole proprietor, self-employed individual filing a Schedule C on your personal tax return, and you had business mileage, you didn't have to actually reimburse yourself the monetary value of those miles. You could just put the miles in on your tax return and get the dollar value deduction for it. Same with the home office. You could just put in what you spent for a home office and get the deduction whether or not your business actually, quote unquote, paid those expenses. Now that you have an S corporation, you can't do those deductions the same way anymore. The corporation, again, is separate from you. So pretend like you work for Walmart or some other company, and how would you get that deduction, right? How would Walmart get that deduction? They would have to actually reimburse you for any kind of business expenses. So you want to put in place an accountable plan. An accountable plan basically just says that the company is not going to reimburse any employees, any business expenses that aren't substantiated. So you have that accountable plan in place, you sign it, you put it in your files, and then you actually follow it, which means when you drive for work, you keep a mileage log still as an employee. Then you submit a mileage log to the company, which is still yourself. I know it doesn't make a lot of sense, but you have to do it. You submit the mileage log to your company, and the company will reimburse you. So you do the mileage calculation rate, and the company actually transfer the reimbursement from the business account to your personal account to reimburse you for the miles you drove. If you happen to spend any, purchase any business items out of your personal account, you would need to reimburse yourself the same way. You should definitely minimize that, buy everything that you can out of the business account that's a qualified business expense so that you're not having to reimburse yourself. The next one is home office deduction. So you basically have to reimburse yourself the percentage of actual expenses that qualify for home office. So you still have to have an office that actually qualifies as a home office, but you can no longer take the kind of standard safe harbor $5 per square foot and reimburse yourself that. You have to add up your actual expenses, mortgage or rent, utilities, figure out the percentage that your square footage of your home office is to the whole house. Maybe it's 10%. Your expenses add up to $30,000. You can reimburse yourself $3,000, and you have to actually, again, reimburse that from the business account to your personal account, $3,000 in home office expenses. So you need the accountable plan. You need to actually do the reimbursements now that you have an S corporation. So hopefully that's helpful. Again, I'll do videos where we dive into each one of these in a little bit more detail, try to keep it a little high level. The video ended up being a little bit longer than I thought it would be, but still shorter than if I had gone into full detail on each one of these. My name is Brad. I'm with Wooten CPA. My goal is to bring peace to your finance and tax responsibilities. The videos here on YouTube are one way that I do that. Please don't forget to subscribe to the channel, hit the bell so that you're notified when new videos come out, and thank you for watching.